Hello everyone, it's Rushabh here and I'm going to talk about Raghuram Rajan today. A bit of his early life and how he managed the Indian monetary policy. He graduated from IIT in 1985, bachelor's in electronic engineering, after which he acquired postgraduate diploma in business administration from the Indian Institute of Management Ahmedabad in 1987. He received a PhD in management from the MIT in 1991 for his thesis titled Essays on Banking. After graduation, Mr. Rajan joined the Booth School of Business at the University of Chicago. He was chief economist at the International Monetary Fund from October 2003 to December 2006. A couple of his research papers are Saving Capitalism from Capitalists, Fault Lines, How Hidden Fractures Still Threaten the World Economy, American Economic Review, Journal of Economic Perspective, The True Lessons of the Recession, The West Can't Borrow and Spend Its Way to Recovery. In 2005, at a celebration honoring Alan Greenspan, who was about to retire as chairman of the US Federal Reserve, Rajan delivered a controversial paper that was critical of the financial sector. In that paper, Has Financial Development Made the World Riskier? Rajan argued that disaster might loom. Rajan argued that financial sector managers were encouraged to take risks that generate severe adverse consequences with small probability, but in return offer generous compensation for the rest of the time. These risks are known as tail risks, but perhaps the most important concern is whether banks will be able to provide liquidity to financial markets so that if the tail risk does materialize, financial positions can be unwound and losses allocated so that the consequences to the real economy are minimized. The response to Rajan's paper at the time was negative. Following a period of economic boom, a financial bubble, global in scope, had now burst. The extent of the global financial crisis had been so severe that some of the world's largest financial institutions had collapsed. Others had been bought out by their competition at low prices, and in other cases, the government of the wealthiest nations in the world had resorted to extensive bailout and rescue packages for the remaining large banks and financial institutions. One of the major banks who were severely affected in the process were the Lehman Brothers. Some of the bailouts had also led to charges of hypocrisy due to the apparent socializing of the costs while privatizing the profits. Furthermore, the institutions being rescued were typically the ones that got the world into this trouble. Furthermore, the institutions being rescued were typically the ones that got the world into this trouble in the first place. For smaller businesses, the poor people, such options for bailout and rescues are rarely available when they find themselves in crisis. There is the argument that when larger banks show signs of crisis, it is not just the wealthy that will suffer, but potentially everyone because of the ripple effect that problems at the top could have throughout the entire economy. Plummeting stock markets had wiped out 33% of the value of companies, that is $14.5 trillion. Taxpayers would bail out their banks and financial institutions with large amounts of money. US taxpayers alone spent some $9.7 trillion in bailout packages and plans. The UK and other European countries have also spent some around $2 trillion on rescue and bailout packages. Such numbers made quickly available are enough to wipe many individual mortgages or clear out third world debt many times over. Even the high military spending figures are dwarfed by the bailout plans. This problem could have been averted, as people had been pointing to these issues for decades. However, during boom, very few want to hear such pessimism. Does this crisis spell an end to the careless forms of banking and finance, and will it herald a better economic age? Or are we just doomed to keep forgetting history and repeat these mistakes in the future? Signs are not encouraging as rich nations are resisting meaningful reform. Now let us look at how RBI policy has been managed since 2008 and also look at how Rajan managed it, and later we will see what effect it has on the Indian economy. In 2008, when repo rate, MSF, CRR all were at the peak, price index and core inflation were also peaking. As an effect of high interest rates and liquidity tightening, inflation was tamed down drastically. But Sensex did not get any help due to liquidity crunch created by the RBI policy. Of course, interest rates alone was not responsible for the Sensex crash. The worldwide recession was mainly the cause. Now let's take a look at what Rajan did when he took over as the RBI governor. Although the government would have preferred a reduction in interest rates to boost the slowing economy, Rajan has instead raised the main lending rate twice to tame inflationary expectations. The repo rate at which the RBI lends money to banks now stands at 7.75% from 7.25% before he took over. Markets have branded him like Subburao, an inflation hawk. Subburao increased the repo rate a record 13 times from 4.75% to 8.5% between March 2010 and October 2011. Inflation still remains high. Headline inflation based on wholesale prices has averaged 8.6% in the past 3 years, and growth has slumped. The Indian economy expanded 5% in 2012-13, the slowest pace in a decade. Rate hikes are, of course, not the only reason for slowing growth. Supply side bottlenecks and government's failure to take reform measures are responsible as well. Rajan believes low inflation is a prerequisite for long-term sustainable growth. The common goal of the RBI and the government is growth with low inflation. Let's take a look at Rajan's policy decisions from September 2013. Rajan is normalizing monetary policy operations by making the repo rate the most important tool to signal interest rates, moving away from levers such as the more expensive marginal standing facility. Before he took over at the RBI, the difference between the repo rate and the MSF, the rate at which the banks borrow from the RBI as the last resort, had widened to 300 basis points. This had promoted large banks such as the State Bank of India and ICICI Bank to increase their base lending rates. Even though the repo rate was not increased, Rajan slashed the MSF rate in 3 phases and raised the repo rate, bringing the gap now to a normal level of 100 basis points. India's foreign exchange reserve has crossed $300 billion in April 2014 from approximately $232 billion since he joined. The above graph is shown in billion rupees. Rupee was at 68 against dollar last year in August 2013, just before he became the RBI governor. Today, rupee is below 60. The objective of any reserve bank is to stimulate growth in an economy while keeping a watch on its inflation. How does it do it? That's when the monetary policy of the Reserve Bank comes in action. Monetary policy is the process by which the monetary authority of a country controls the supply of money, often targeting the rate of interest, for the purpose of promoting economic growth and stability. There are different tools used in monetary policies, some of which are cash reserve ratio, open market operations, repo rate, reverse repo rate, and marginal standing facility. Cash reserve ratio is the percentage of a bank's total deposits from the public that must be kept at the Reserve Bank. It is generally an unused tool of monetary policy. Increasing the CRR result in lesser liquidity in an economy and simultaneously increase the cost of money, whereas reducing the CRR will have an opposite effect. Open market operation is the most used tool of monetary policy. It refers to either buying or selling of bonds by the Reserve Bank to induce or suck out liquidity from an economy. Repo rate is the rate at which the Reserve Bank lends money to commercial banks. Whenever banks have any shortage of funds, they can borrow from the Reserve Bank. A reduction in the repo rate helps banks get money at cheaper rate and vice versa. The repo rate in India is similar to the discount rate in the US. This is an expansionary monetary policy. Reverse repo rate is the rate at which the Reserve Bank borrows money from the commercial banks. Banks are always happy to lend money to the Reserve Bank since their money is in safe hands with a good interest. An increase in the reverse repo rate can prompt banks to park more funds with the Reserve Bank to earn higher returns on idle cash. It is a tool which can be used by the Reserve Bank to drain excess money out of the banking system. That's all for now, guys. Rushabh here signing off, and until the next update.